Okay, good. Everybody can. Okay, so there's a little. Sorry, there's just a little delay. Now I see everybody's popping up in the chat box. Okay, good. So you can see me loud and clear. Okay, sorry about that. Thought we were having another a technical issue. I'm old enough that computers and I are not on a first name basis. So thank you, everybody. You see the desktop. It says Pinnacle Method Workshop. Excellent. Welcome. All right, we are going to talk today about how simple a concept options are. Okay, so my name is Steve Moses, and I'm the options guy here at the Pinnacle Institute, and we're going to talk about options today. All right, and we've got some workshops coming up, and I'll talk more about these when at the end of the we're going to go about 45 minutes to an hour today. So I'll talk about some of our introductory and advanced workshops coming up and things that you could, hope to get out of them if you join us there. And we'll touch on that. Before I get into the disclosures, what if everybody would like to just put in the chat box where you're from? I know that we probably have a lot of folks here in America. I said good morning because I'm coming to you from Napa Valley, California, where I live. Moved out here a few years ago, where the wine is, and that was nice. I'm originally back from Brooklyn and Jersey and New York, back east. Spent a lifetime out there, so got rid of my accent. I don't sound like Tony Soprano anymore, unless I want to. But anyway, so South Africa, wow, excellent. Kansas City, very cool. Love your barbecue. All right, so we're going to introduce you to options in just a second. All right. Before I do that, I just want to go through a couple of quick disclosures. One, we are not investment advisors. We do not provide investment advice. Everything that we are going to talk about today, guys, is about trading about options, but is for educational purposes only. Okay, we've got a couple of folks from Georgia. Welcome. For educational purposes only. Okay, there are no guarantees of success in the market, whether you're trading stocks, options, futures, forex. There are no guarantees in the market that you will make money or not lose money. Okay, according to the FTC guidelines, available research shows that most day traders are not profitable, and any analysis given gives no guarantee in the stock market. And finally, boys and girls, all trading comes with risk, right? Right. There is no such thing as a risk-free trade. I mean, think about it. If there was a guaranteed trade, if there were trades that were guaranteed to make a profit, would I be here talking to you? Okay. Every trade comes with risk. There's no guarantee of success in the stock market. As a matter of fact, the one thing what makes a successful trader is they know how to manage the risk. They know how to lose. And that's actually very important. All right. And everything you're going to see today is copyrighted. All right. Options. The greatest invention of all time. I want you to think about this. If I were to ask you, what is the greatest invention of all time? What would you say? Well, some people would say fire. That's actually Tom Hanks from that movie. What was it? Not Stranded movie when he was on the island. But that's, fire was a pretty good invention, right? Okay. How about the wheel? Wheel's a pretty good invention. Personally, I think single malt scotch may have been the greatest invention of all time, but that's just me. So anyway, all three were great inventions: fire, the wheel, single malt scotch. However, I think that options are the greatest invention of all time. And here's why. And I'm going to introduce you to the concept of options. As the title of the YouTube webinar stated, most people think options are hard. Most people think options are risky. Most people think I can't make any money trading options. They expire worthless, blah, 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 blah. Well, one of the reasons that options I think are the greatest financial invention of all time are because it is the one asset class where you can be wrong directionally and still make a profit. Now think about that for a second. If you buy stock goes up, you make money, stock goes down, you lose money. You short stock Stock goes down, you make money. Stock goes up, you lose money. Same thing with futures, same thing with forex, same thing with real estate. Those are all directional trades or directional investments. If you get the direction right, you make money. If you get the direction wrong, you lose money. Right? Right. Options, there are option strategies where you can be wrong directionally. You can enter a bullish options trade. The asset can go down and you can still make money. You can enter a bearish options trade. The asset can go up and you can make money. You can be wrong. You just can't be really wrong. You can't be Enron wrong, Bear Stearns or Lehman Brothers wrong. You can't be going out of business wrong, but you can be somewhat wrong. How cool is that? Okay. Well, that, in my humble opinion, is the, and remember, my name is Steve Moses, so that may be my opinion, but you're getting introduced to options today from Moses. Just remember that, okay? You can even email me. It's the 21st century. Moses has an email address. I mean, who doesn't, right? Probably has a Twitter feed too, but we won't get into that. All right, options, the greatest thing ever invented. Now, there are only two options, calls and puts, okay? That's it. There are call options and there are put options. Okay. And all options do is they give you the right to do something in the future. They're contracts, if you will, and they give you the right to do something in the future, or you take on an obligation to do something in the future. If you buy options, you're buying the right to do something in the future. When you sell options, you're taking on an obligation to do something in the future. Does that make sense, everybody? Just conceptually, from the 5,000-foot view, okay? Now, let's be real. I mean, why are we in the market? Why is everybody on the webinar today? Why are we in the market? Why are we trading or investing in options or anything? For one reason, to make a profit. I mean, if I ask people why are they in the market, why do they trade stocks, sometimes you'd be amazed at the answers people give me. Oh, I want to support the marketplace and I want to create jobs and I want to blah, blah, blah. Yeah, cut me a break. We're in the market for one reason, to make money, to make a profit. And while we're trying to make a profit, lose as little as possible. Okay, now, I am going to ask a question. Who's never traded an option before? Who's never traded options? Who's on the webinar here? Who's never traded options? Anybody? I mean, I have no idea. I know where some of you are from. But who's never traded options? Okay, I'm going to bet most people, if you ask your list of friends, most people have never traded options. Most people would say they've never traded options. And again, if I was going to ask you why, most people who have some trading or investing experience would say, well, I don't trade options because they're risky, they're complicated, they're hard to learn, most of them expire worthless, blah, 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 blah. Well, that kind of is true to some degree, but let me ask you a question. Trading options can be hard. Learning how to trade can be hard. But guys, learning how to be a doctor is hard. Becoming a lawyer is hard. Becoming a plumber is hard. Becoming an actor or a baseball player or a judge or an accountant is hard. Okay, it's all hard. But it's hard until what? Until when? It's hard until you're trained by someone who knows how to do it. It's hard until you're trained by a professional. It's all hard when you're new, when you're a rookie with no experience. So it's hard until it's not. Now, the first thing I'm going to introduce you to today is the concept of what options are. I'm not going to teach you how to trade them today, because if you don't know what they are, you can't even begin to trade them. But the title of the program today is Remember the Doritos Coupon. I'm going to share with you that if every one of you raised your hand and said you haven't traded options, I'm going to say you have. You've just called them something else. As a concept, you all know what options are. Okay? You've just called them something else. Okay? Now, that's why not. Okay? Because you thought they were hard and you thought they were complicated. Now, take a look at this. Does everybody know what these are? Now, I know we have some folks who are maybe not from the U.S. and all, but this is a flyer from the local supermarket. What are all those items on the flyer? Anybody? What are those? Anybody? Those are coupons. Does everybody know what a coupon is from a store? Does everybody know what a coupon is at the supermarket? Yes? No? I mean, if you don't know what a coupon is, it could be a long hour. But okay, I'm assuming you all know what a coupon is. Okay. Now, let me ask you a question. If I'm walking around Acme is the name of the supermarket. If I'm walking around the supermarket with this flyer, do I have to buy any of these products that they are advertising? No, of course not. I don't have to buy any of these products. Okay. But if I want to buy any of these products, what price do I pay? The price on the product or the price on the coupon? The price on the coupon, right? Until when? Until the coupon expires, right? Does everybody get that? You're walking around the supermarket, you can buy any of these products at the sale price until the coupon expires. Guess what? That's an option. Let that sink in for a second, guys. That's an option. If you have this coupon, do you have to buy any of these products? Of course not. What do you have? You have the right to buy this product at this price until an expiration date. Does that make sense? Wow. Well, remember what I said about options. When you buy options, you buy the right to do something. When you sell options, you take on an obligation to do something. Does that make sense? Okay, now, we have established that if I'm walking around the supermarket with this flyer, okay, I don't have to buy any of these products, but if I want to buy any of these products, I can pay the coupon price, and let's say the coupon expires tonight at 11 o'clock, Friday night at 11 o'clock, okay, the end of the week. So I have the right until tonight at 11 o'clock p.m. to buy any of these products at that price. All right. In that flyer there's going to be a coupon. Okay. Now, there's a coupon that says I can buy a bag of Doritos for 99 cents. In the flyer on another page is a coupon that says I can buy a bag of Doritos for 99 cents. Well, when I go to aisle 7, when I go to the chip aisle, the bag of Doritos is $3.99. Okay. Well, let me ask you a question. If I have the right to buy, if a bag of Doritos is $3.99, and I have the right to buy Doritos for 99 cents, what is that coupon effectively worth to you? Anybody? I have a $3.99 bag of Doritos, a 99-cent coupon. What is that coupon worth to you? No, it's worth $3. I'll tell you why, Jeffy. Think about it. You have a coupon that says you can buy Dorito. You can buy a $3.99 bag of Doritos for only 99 cents. There's $3 of value there. That's what you're saving, right? $3. No, not even $2.99. It's a $3.99 bag of Doritos and a 99-cent coupon. $3 of value. Okay. Now we call that intrinsic value. Okay. So now here's the deal. Got it. There you go. That's okay. Your phone has a calculator on it. You're okay. Jeffy, is it Jeffy with, do I pronounce the hard J? Jeffy or Yeffy from Kansas City? Okay. So it's worth $3. Are you with me? Okay. Now, this coupon is worth $3. Now, it's not money. I can't go out and spend it to pay a debt, but the coupon is worth $3. Okay, Heffy, that's what I thought. Okay, so the coupon is worth $3, and it doesn't expire until tonight. Now, if I don't want the Doritos, I'm 62. I don't eat Doritos anymore. I mean, they're not really food anyway. So, I mean, I don't eat Doritos. But I have a coupon that has $3 worth of value. I don't want the Doritos. What could I do with the coupon? Could I sell it? Yeah. I know you don't think of selling a supermarket coupon, but couldn't I sell it? I have something worth value, worth $3 of value. Could I sell it to somebody before it expires? Sure. Who am I going to sell it to? Somebody who wants the Doritos, right? Somebody with the munchies. Maybe somebody who lives in Colorado where pot's legal, okay? Somebody has the munchies. Okay, now I want you to think about this. I'm going to sell Heffy the coupon for $1. Now just follow my logic here, okay? I'm going to sell Heffy a coupon for $1, okay? He paid $1 for the coupon. The coupon allows him to pay 99 cents for the Doritos. Are you with me? Now, if Heffy uses the coupon, he ended up paying $1.99 for a bag of Doritos that costs $3.99. Does he come out ahead? Is that a good deal for you, Heffy? Say yes. By the way, I sold you the coupon for $1. Did I make a profit? Yes, I did. I sold you the coupon for $1. If you use the coupon and buy the Doritos for 99 cents, you paid $1 for the coupon, giving you the right to pay 99 cents for the Doritos. So you get a $3.99 bag of Doritos for $1.99. I made a profit and you come out ahead. Is that a good deal, Heffy? Yep. Okay. I sell Heffy the coupon for $1. Heffy decides, you know what? I don't really want the Doritos. I changed my mind. But I've got a coupon that still has value that hasn't expired yet. Heffy turns around and sells the coupon to CW. Okay? Heffy sells the coupon he bought for $1, sells it to CW for $2. Did Heffy just make a profit? Buying a coupon for $1 and selling it for $2. Did Heffy make a profit? Yes, he did. Did he ever have to buy the Doritos? No, he didn't. Did he ever need to have $3.99 on him, which was the cost of the original Doritos? No, he didn't. So I made a profit, and Heffy's made a profit. Okay, CW paid $2 for the right to pay 99 cents for the Doritos. If CW uses the coupon, what does he get the Doritos for? $2.99. What's the price on the bag? $3.99. Is CW coming out ahead? Yes, he is. Okay. CW decides, you know what? I changed my mind too. I don't want the Doritos. Could CW turn around and sell the coupon to Arthur for $3 before it expires? Say yes. Did CW buy a coupon for $2 and sell it for $3 and make a profit? Yes. Did he ever have to buy the Doritos? No. Did he ever have to have $3.99 on him? No. Guys, what's going on here? Everybody's making a profit buying and selling coupons, and ain't nobody bought a Dorito yet. Are you with me? Now think about it. When I had the coupon, when Heffy had the coupon, when CW had the coupon, when Arthur had the coupon, all they had when they had the coupon was the right to buy Doritos. When? In the future. They had the right, but not the obligation to buy Doritos for 99 cents, no matter what the price is on the store on the bag when they get to the store. Are you with me? Now, I need you to think about this for a second. I know why Heffy paid $1 for a coupon that was worth $3. I know why CW paid $2 for a coupon worth $3. But why would Arthur, and I want you to think about this for a second, why would Arthur pay $3 for a 99-cent coupon? Because if Arthur uses the coupon, he paid $3 for the right to buy Doritos for 99 cents. He gets the Doritos for $3.99, but that's the price on the bag. So why do you think Arthur would pay $3 for a 99-cent coupon if he could, in fact, just go out and buy the Doritos? Any thoughts? Think about that for a second, because it makes a difference. What if Arthur thought the price of the Doritos was going up? Because the reality is, ladies and gentlemen, Heffy, CW, and Arthur, regardless of what you paid for the coupon gives you the right to buy Doritos for 99 cents, no matter what the price is on the bag when you get to the store. What if Arthur gets to the store and that bag of Doritos has a $10.99 price tag on it for whatever reason? All right, for $10.99, those better be some magic Doritos. Okay? Well, it's not just that he wants to own the Doritos, CW, because why pay $3 for a coupon to spend 99 cents? Why go through all that when you could just go buy the Doritos for the same $3.99? It's not that he wants to own Doritos necessarily. It's that he thinks the price of the Doritos is going up. Follow me for a second. What if Arthur gets to the store with his 99-cent coupon that he paid $3 for? Whatever the reason is, Effie, it could be inflation, it could be supply and demand. The reason doesn't matter. Arthur gets to the store and the bag of Doritos is priced at $10.99. Now what is the 99-cent coupon worth? $10. What did he pay for it? $3. What's his profit? $7. Are you with me? So Arthur bought the coupon for $3, which is what it's worth, because he thought the price of the Doritos was going up. Are you with me? Now, when we own the coupon, we have the right, but not the obligation, to buy Doritos for 99 cents a bag, no matter what the price is on the bag when you get to the store. What does the supermarket have? If we have the right to buy Doritos, what does the supermarket have? They have an obligation to do what? To sell us Doritos for 99 cents a bag, come hell or high water, until 11 o'clock tonight when the store closes. Right? Right. What if I get to the store and the supermarket says, hey, sorry, Steve, we're out of Doritos. The coupon was very successful. The Olympics are on this weekend. Everybody's throwing a party. Everybody came in and used the coupon and bought Doritos. We are out of Doritos. Sorry, I have no Doritos to sell you for 99 cents a bag. What does the supermarket have to do? Well, in the U.S., what is it called? What do they have to give me? Anybody? Come on, guys. They have to give me a rain check. They owe me, they are obligated to sell me a bag of Doritos for 99 cents. So if they're out of it, they give me a rain check, and then when I get the Doritos, I come in and I get the Doritos. Okay, thank you, CW. Now, what if the supermarket says, hey, look, Stevie, I can't even give you a rain check, dude. There was a fire at the Doritos factory. There is no more supply of Doritos, a lot of demand. It's going to cost me $7 a bag to buy the Doritos. I can't afford to buy Doritos for $7 a bag and sell them to you for 99 cents. I'll go broke. Yeah, guess what? Sucks to be you. Doesn't matter what you have to pay to get the Doritos. You are obligated to sell them to me at 99 cents until tonight at 11 o'clock. If I get to the store tomorrow morning and you're out of Doritos, no obligation, the coupon expired. Are you with me? So we have the coupon, we have the right to buy Doritos. The supermarket is obligated to sell us Doritos at 99 cents. Does that make sense, everybody? Now, by the way, if they're not going to give me a rain check and they're not going to honor it, what are we going to do? I'm from New Jersey. I'm going to sue them. I'm kidding, but you get the point. Now, by the way, for what it's worth, what if CW gets to the supermarket with his 99-cent coupon, and for some reason the bag of Doritos is priced at 89 cents? What are you guys going to do with your coupon? What are you going to do with your 99-cent coupon if the Doritos are priced at 89 cents? Anybody? I mean, you could throw the coupon out. You could try and sell it and pawn it off to somebody else. You could hold on to it and hope the price of the Doritos goes back up, but you're certainly not going to use, well, you could do that, CW, but you're certainly not going to use it. Who's going to use a coupon and buy Doritos for 99 cents when they can buy it on the open market for 89 cents? Nobody. Well, in my neighborhood, we call that a Red Sox fan. Okay? Nobody. Does that make sense? Well, you guys in Georgia, you might call it a Met fan, but you get the point. All right? So, guys, There's your coupon. There's the bag of Doritos. There's the coupon. Now, it has $3 of intrinsic value. Okay? And the expiration date, Friday night at 11 o'clock. Now, by the way, this is what we talked about. So look at this. Here in the middle, a $3.99 bag of Doritos, a 99-cent coupon is worth $3. But as the price of the Doritos goes up, the coupon doesn't change. As the price of the Doritos goes up, the intrinsic value of the coupon changes. Does that make sense? As the price of the Doritos goes down, the intrinsic values goes down. But if the price of the Doritos ever goes below the price of the coupon, it has no value. So you're just not going to use it. You could let it expire, because then if you really want the Doritos, you just go to the store and buy the Doritos for 89 cents. Even if Arthur paid $3 for the coupon, which that stinks because now he could buy the Doritos for less than 99 cents, but he still gets the Doritos for $3.89 instead of using the coupon and paying $3.99. Does that make sense? Okay, now, now, this is not a Doritos class. This is not a Doritos introduction. Let's talk about stocks. Because guys, if you understand the whole coupon scenario that I just laid out for you, you understand options. Because all options are coupons. If you want to think of it this way, options are coupons. They give you, if you buy a certain option, if you buy a call option, you didn't buy a stock. See, guys, there are two options, calls and puts. Call options, when you buy a call option, that gives you the right to buy a stock at a set price, no matter how high the stock goes. Just like you had the right to buy Doritos for 99 cents, no matter how high the Doritos goes. If you buy put options, you have the right to sell a stock at that price, no matter how low it goes. How cool is that? Think about insurance, by the way. You have $1 million house, you insure it for $1 million, the house burns to the ground. You still get to sell it for $1 million. You did lose the asset, you lost the house, but financially you're made whole. So buying calls is like buying the Doritos coupon. Selling calls is like the supermarket. They are obligated to deliver it to you. All right. So earlier today, I looked at IBM. I just chose a stock. I'm not recommending IBM. It's a stock everybody knows. It's easy to spell, IBM. Okay. Earlier today, IBM was trading at $141.75 a share. That's it. Now, options are sold in contracts. And each contract gives you the right to buy or sell 100 shares of stock. Okay? Do any of you trade futures contracts? Because futures give you the right to do a certain amount of things. If you're trading oil futures, you have the right to buy a certain number of barrels of oil. If you're trading soybean futures, one soybean futures contract gives you the right to buy or sell, or the right to buy or the obligation to sell a certain amount of soybeans or sugar or coffee. You get the point. So options are contracts. If you buy a call option, you're buying the right to not buy one bag of Doritos. See, the coupon is in increments of one. You buy the coupon, you have the right to buy one bag of Dorito for 99 cents. One call option gives you the right to buy 100 shares of stock. Okay. If IBM was trading at $141.75 and you wanted to buy 100 shares of that stock, it would cost you $14,175. Okay. But we don't want to buy the stock, just like Heffy, CW, and Arthur didn't want to buy the Doritos. What if instead of buying the Doritos, we bought a coupon? What if instead of buying IBM stock, we bought a call option or a coupon, giving us the right to buy IBM stock at $135 a share? Now, if you're going to buy IBM stock, what direction do you think the stock is going in? Duh, obviously up. So you would want to buy the stock at a demand area or a support area. You'd want to buy the stock for whatever reason, technical or fundamental, you use to think that the stock is going up. Does that make sense? Okay. Just like Arthur was buying the Doritos for $3 because he thought buying the Doritos coupon for $3 because he thought the price of the Doritos would go up. Okay, so I just want to be clear. You're buying IBM stock if you are because you think the stock's going up. Well, if you're buying a call option, if you're buying a coupon giving you the right to buy the stock, you still want to buy that option, buy that coupon, the same place where you would want to buy the stock, and for the same reason. But here's a benefit of the option. By the way, FECW and Arthur, nobody paid $3.99 for that coupon. It's a derivative. They used leverage. Now, as I mentioned, options are sold in contracts, and each contract gives you the right to buy 100 shares of stock. So this morning, I looked up this option, an October 135 call option, which, by the way, let me ask you, well, the answer is right here. If I have remember guys, I have the right to buy Doritos for 99 cents. The bag of Doritos was $3.99. That coupon was worth $3. If IBM is trading at 141.75 and I have the right to buy IBM at 135, what is that coupon or what is that option worth? $6.75. Right? Right. Now, that option that's worth $6.75, to buy it is going to cost you more than $6.75. It's going to cost you $8.45. Why are you paying more than it's worth? Okay. Why are you paying? Actually, that should be $1. That's not $2. That's you know what? My math was off a little bit. We're going to just make a change right there for our purposes today. Sorry about that. I had a little. We're going to make that $8.75. All right, there we go. All right, now. Sorry about that, guys. I get dyslexic once in a while and I flip numbers around. The premium, if the premium was $8.75 and the option was worth $6.75, why are we paying more for it than it's worth? This is why. This option expires in 79 days. We're paying $2 for 79 days of time. We're paying more than the option is worth for 79 days of time. And I'll share with you why. Does that make sense, everybody? So still, if we're paying $8.75 for the option, it's going to cost us $875, and we're going to pay $87.50. Okay? All right. Now, there we go. The option is going to cost us $875. Now, what does this account management mean? I want you to think about this, guys. If I'm going to buy 100 shares of IBM stock, it's going to cost $14,175. What's the most I could lose? $14,175. If I'm buying a call option for $875, what's the most I could lose? $875. Now, why is the option going to cost $875? Because an option contract gives you the right to buy 100 shares of stock. So if the option premium is $8.75 times 100, it would be $875. It's worth $6.75, but if we want to buy it, we're going to pay $8.75. Now, why are we paying more than it's worth? Because we're hoping to hit a home run, and I'll show you that in a second. Now, what does this account management mean? Guys, one of the benefits of options is this. If you're going to get into a trade, should you put 100% of your account in one trade? Yes or no? I'm hoping you all are going to type in no. You're not going to put 100% of your account in one trade or one investment. Okay, that's kind of nuts, putting all your eggs in one basket, as they say. So I follow personally myself a 10% rule. I would not put more than 10% of my account in any one trade. Now, I know if you're spending $14,175, IBM would have to go to zero to lose the whole $14,175. And the probability of IBM going to zero is pretty small. But hey, one never knows, do one? Okay? So if I wanted to spend $14,100 and I don't only want to risk 10% of my account, I would need at least $140,000, $141,000 account. Well, let's face it, most people don't have an account that big, which means you can't buy some of the shares that you want to buy. But if I'm buying a coupon, if I want to profit off of IBM's move and I can't afford to buy IBM shares, what if I bought the right to buy IBM shares for $875? I could do this trade in an account with less than $9,000 in it. Now, all of a sudden, IBM becomes affordable. Does that make sense, everybody? Just like, I mean, think about it. Maybe you couldn't afford, maybe when I sold Heffy the coupon for $1, he couldn't afford $3.99 for the Doritos. But could he afford $1 for the coupon and $1.99 for the Doritos? Yeah. So if I can't afford $14,000 worth of stock, can I afford the right to buy that much stock for only $875? And I can profit off of that move in an account that has less than $10,000 in it and still follow appropriate money management rules. Are you with me? Now, remember, no matter how high IBM goes up in the next 79 days, we have the right to buy IBM stock at what price? $135 a share. If IBM goes to 500 in the next 79 days, why do we still get to buy it at $135? For the same reason, if Doritos are $20 a bag, you still get to buy them for 99 cents because somebody is obligated to sell it to you at that price until the coupon/option expires. Are you with me? Does that make sense? Conceptually, are you now seeing how simple options are as a concept? Now, trading them is another issue. Trading is not the easiest thing in the world to do. I think we could all agree with that. If anybody would just put in the chat box, do some of you have trading experience? Have some of you never made a trade in your life? Just give me a little clue here as to your experience level, your background. Okay. But my point, no experience. Okay, great. Welcome aboard, guys. Okay. So my point here is trading has risk. All right. And if you think now trading, well, as a matter of fact, guys, I tell you what, I'm going to give you the secret to trading right here. All right. Heffy kind of touched on it before. You're going to get the secret to trading. Very good, Philip. You're going to get the secret. What do you trade? You're going to get the secret to trading right now from Moses. If you do what I'm about to tell you right now, okay, your life will never be the same. Here it is. You ready? Write this down. Buy low, sell high. We're done. Thanks for coming. Well, actually, I'm not kidding. If you could buy low, sell high, life would be great. The problem is define low and define high. Okay? Same thing. Oh, futures. Excellent. Futures is like options, Philip. It's just that you don't pay time value. Okay? Futures is a contract just like an option. If you're trading oil futures, you have the right to buy oil at a certain price. If you sell an oil future, you're obligated to sell oil at a certain price. So I know you get that. So guys, we all want to buy low and sell high, or sell high and buy low. The problem is define high and define low. Okay? Now, trading, and even if you want to buy low and sell high, in order to buy low, the price of an asset has to be dropping. Do the prices of assets drop on good news or bad news? Usually bad news. Well, how many retail traders are prepared to buy a stock that's tanking on bad news? Not many. Okay. What do you want a stock to do when you buy it? Go up. How do you buy low? It's got to be going down. What if you could buy a stock or an option where you think it's going to stop going down? And by the way, that's what we teach at the Pinnacle method. How to identify supply and demand areas to know where a downtrending asset is going to stop going down and an uptrending asset is going to stop going up. That's how we're going to That's what we teach. Okay, and I'll touch on that in a few minutes. So I just want to be clear here, guys. We have the right to buy Doritos for 99 cents a bag until 11 o'clock tonight, no matter what the price is, when FACW, Arthur, Philip, or anybody walks into the store. Okay. We have the right to buy IBM. If we buy this call option right now, we have the right to buy IBM at $135 a share, no matter how high priced the stock is, until October 15th at 4 o'clock Eastern time when the market closes and the coupon expires. Are you with me? Good. Okay. Now, the reason we're paying $2, I'm going to show you right now. Here is the point of options, guys. So let's look over here. Let's look on the left at first. Let's look at the stock. Okay. So I rounded IBM stock from 141.75 to 142. If you bought IBM stock at 142, and let's say your opposing area, your price target, because obviously when you buy stock, you have to think you know where it's going. If you didn't think IBM was going over 142, why would you buy the stock? You wouldn't. If you're buying the stock and you're following a risk reward parameter, you've got to make enough profit to offset the potential risk. So let's say your opposing resistance area or your opposing supply area was 170 bucks. So simply put, guys, if you buy a stock at 142 and sell it at 170, you made $28 a share, and that's a 20% rate of return. Does anybody have a problem with that trade? Anybody have a problem buying a stock at 142, selling it at 170, making a 20% rate of return and making $28 a share? If you have a problem with that trade, we have support groups for you, okay? Well, we're not buying the stock, okay? We already talked about that. Why aren't we buying the stock? Because maybe we don't have $14,200 or $140,000 account. Well, if the stock was at a demand zone, whatever price you would buy the stock, instead of buying the stock, what if we bought the call option? Now, we're not buying, now just listen to me. We're not buying the stock at 142. We're buying the right to buy the stock at 135 when the stock is at 142. That's when we're buying this option. So we can choose to buy the stock at 142, or we can buy a 135 coupon when the stock is at 142. Okay. We already said our target was 170, the stock getting to 170. Okay, guys. Remember the Dorito. If the stock gets to 170, what does a 135 call option or 135 coupon have to be worth? Intrinsically, it has to be worth $35. What's our cost? $8.70. Well, we said, okay, $8.45. I didn't change the number on this one. That's a profit of $26.65 on an $8.50 investment. That is a 315% rate of return. Are you with me? Holy moly. Now, I already know what some of you are thinking. The stock buyer actually made more money. The stock buyer made $2,800. We only made $2,665. Oh, that's a shame. But they had to spend $14,200 to make $2,800. We only spent $2,600 to make $845. I mean, we only spent $845 to make $2,665. Unbelievable. Now, the only question is do we know the stock's getting to 170? Of course we don't. But we don't know if the stock's getting there when we buy the stock. Philip buys a future. He doesn't know if it's getting to his target. If you buy stock, if you buy real estate, if you buy anything, you don't know if the value of that thing is going to appreciate, right? That's what trading and investing is all about. You buy mutual funds. You don't know if the market's going to go up. Remember, guys, if I could guarantee IBM was getting to 170, I wouldn't be here talking to you nice people. I would back the truck up. Beep, beep, beep. That's the sound of me backing up the truck and taking out a mortgage, a second mortgage, so I could buy as many shares or as many call options as I could afford. That's like knowing who's going to win the game before it's played. That's like knowing what the dice are going to roll or the roulette wheel is going to land on. Okay? Wow. But guys, this is the concept of options. That's it. Okay? If you're bullish on IBM and you want to buy stock, knock yourself out. Now, by the way, just to be fair, there are stocks have three benefits, in my humble opinion, that options don't have. These are the only benefits I think that stocks have that options don't have. Stocks don't expire. Okay? I mean, I guess, that's I mean, again, Enron notwithstanding, stocks don't have an expiration date. Okay? Stocks pay dividends, or at least the ones that do. Remember, if you own an IBM call option on dividend day, you don't get the dividend because you don't own the stock. You only own the right to buy the stock. So you're not a shareholder, you don't get the dividend. So, stocks don't have an expiration date. Stocks pay dividends, the ones that do, and stocks have a better break-even price. Meaning if you bought a stock at 142 and sold the stock 79 days later at 142, commissions notwithstanding, which you don't even really pay those today, but commissions notwithstanding, you broke even. No harm, no foul. But guys, if we bought this option when the stock was at 142, and in 79 days the stock was still at 142, we are going to lose the time value of what we paid. We're going to actually lose a few bucks. The stock is going to have to go up somewhat to make a profit on the option or to just break even on the option. Okay, but you know what? I can live with those three differences for this down here. I can live with an expiration date. I can live without getting dividends. Who cares about a dividend? Who cares about a 70-cent dividend if I'm reducing my cost 95% on the option from the stock? Now, the only question is, when you trade the stock, you need to think you know where the stock is going. You only need to care about the where. Where's my entry? Where's my stop loss? And where's my profit target? When you trade options, you still need to know about the where, but you also need to know about the when. Because if IBM gets to 170, but not until November 1st, you lose. It didn't, just like walking into the supermarket with a coupon tomorrow after it expired. They are under no obligation to sell you Doritos for 99 cents a bag tomorrow. Does that make sense? That's it, guys. If you understood the humble Doritos coupon, all a call option is an IBM coupon instead of a Doritos coupon. Now, obviously, this is $875 is more expensive. Duh. Okay. Now, one benefit to wanting to learn these is, aside from incredible rates of return when you're right, less risk even if you're wrong. And by the way, how about this? What if you bought 100 shares of IBM for $14,200? And you said, you know what? I'm going to put $1,000 stop loss on the trade. If IBM starts to go down, goes below my demand area, I'm willing to risk $1,000. Matter of fact, if you're using a 3-to-1 reward to risk, how about this? If you're using a 3-to-1 reward to risk, you're risking $9. If you're hoping to make 28 when you're right, you've got to be willing to risk 9 when you're wrong. Does that make sense, everybody? A reward to risk ratio. If you're hoping to make 28 bucks, you're risking 9, which means you're risking $900. Now think about this for a second. Let's say you enter a stock trade for $14,000 and you get stopped out for a small loss. And remember, you've got a $140,000 account. A $900 loss is no big deal. I mean, it's $900, don't get me wrong. I'm not gonna not just going to burn $900, but okay. But it's no big deal. It's the cost of doing business. You got stopped out for a small loss. Most of you would feel real good about taking only a $900 loss if you're wrong. Well, by the way, the most you could lose on the option was $845. And you should never take max loss on an option. I have never taken max loss on an options trade in my life. Have I had losses? Of course, for God's sakes. Okay? But I have never taken max loss. And the reason for that is right here. An option may not have any intrinsic value, but it's going to have time value. Well, think about it. This option has value beyond what it's worth intrinsically because there's time left. So what if we get stopped out of our IBM trade this week or next week? Today's Friday. What if we get stopped out next week? There's still 72, 73 days till expiration. We're going to take a loss on the option, but it's not going to be anywhere near the 845. Does that make sense, everybody? Wow. So you feel real good about taking a small $900 stock loss, and that's still more than any loss you would take on the option, even if you took max loss, which you should never take if you learn how to trade. Now, what we teach at the Pinnacle Institute is how to get into a bullish trade or a bearish trade as close to where you know you're wrong as possible. You want to buy IBM stock? You want to buy it at a demand zone? You want to buy a call option at a demand zone? You want to watch a stock that's going down, figure out where you think it's going to stop dropping? Wow. That's our supply and demand methodology at work. So the whole point here, guys, is options conceptually are simple. Trading them live in real time, not so simple. Somebody, I think it was Philip, said they're paper trading, okay? Or Heffy, sorry. Heffy's paper trading. Paper trading is great. We all need to practice. Pilots practice on simulators. Surgeons practice on dead people. Lawyers practice arguments before they go in front of a courtroom. Everybody practices, okay? We should paper trade. We should practice, okay? However, practice is not real. You're not trading real money. You could take a large loss in a simulated account. Anybody ever play Monopoly? Anybody ever go bankrupt in Monopoly? Anybody ever get upset? You lost a big stack of blue $500 bills? I mean, come on, okay? You go bankrupt in Monopoly, nobody cares, okay? However, in real life, if you bought one call option for $845, that's not, I mean, I don't mean to be glib, that's not a lot of money. If you're trading and you've got to, I mean, it's $845, but it's not a lot of money. Okay, but it's real. It's $845. If you lost it, you'd be upset. If you did something stupid, you'd be. I mean, still $845. Granted, if you're Warren Buffett, it's really not anything you're going to notice. But for most of us, $845 could be a car pay. Could be 3 months of car payments. I mean, it could. I mean, it's some real cash. And if you lost $500 on a trade, okay, that's real. Trading live is managing your emotions, not just managing the trade. All right. Now, everybody get this. How cool is this right here? Who thinks options are amazing so far instead of trading stock? Now, you have to learn which strike. What I haven't gotten into right now is you have to learn which strike price to look at. You have to learn which expiration date to choose. I just chose 135 in October for our educational purposes today. But there are options that expire today. There are options for IBM that expire next Friday. There are options that expire in August, in September, in October, November, December. There are options that expire in January of 2023. How far out do you go to choose your expiration date? Some stocks like, Apple or Facebook, you might have 50 different strike prices, 50 different coupons to choose from. You have to choose, you have to get not just the direction right, but you have to choose the right strike price and the right expiration date. And the right expiration date. Now, who knows what the FANG stocks are? The logos should give it away. Facebook, Amazon, Apple, Netflix, Google. Who wishes they owned these stocks and profited off their meteoric rise the last few years? Every hand should better be going up. These are the stocks, by the way, that have driven the market. These are the stocks that have taken the NASDAQ and the S&P, or at least as of earlier this week or last Friday, to all-time highs. Okay? Well, who wishes they owned these stocks? Yes, CW, me too. Here's the problem with these stocks. As of last night, look at the prices of these stocks. Apple's the bargain in the bunch at $145, $14,500 to buy 100 shares of Apple. You want Facebook? $37,000. Netflix, $51,000. Google had earnings 2 days ago. The stock was up 100 points. But you want to buy 100 shares of Google? $272,000. All right? One share, $2,700. Some people can't afford that. 10 shares, $27,000. And even after Amazon is tanking this morning, Amazon's down like 250 points today. They had earnings last night. It's still a $3,400 stock, $340,000 for 100 shares of Amazon. Well, Philip, is it crazy? I don't know. Some people drive around in a Rolls Royce. That's a $250,000 car. Some people drive around in a Jaguar or a Mercedes. If you have money, we're not going to get into cheap or expensive. Okay? Look, there are a lot of people on this webinar. When I teach classes, there are people that might have multi-million-dollar retirement accounts. Guys, there are people that buy a 20-cent Bic pen and people who buy a $200 Mont Blanc pen. There are people with a $5,000 Rolex watch or a $20,000 Rolex and people with a $50 Swatch watch. Let's not get into what someone thinks is crazy. I respect Philip's opinion, but you got the money. I'm venturing that none of you buy the cheapest anything. Okay? If you have the money, do it. Okay? Now, look, I live in Napa Valley. I moved here because I'm a wine guy. At one point in my life, 20 years ago, I lived in New Jersey and I had a wine cellar with 1,500 bottles in it. And there were bottles of wine that I paid, and this was 20 years ago, over $100 for. Well, I have a friend who thinks it's grape juice. He thinks I'm nuts. $100 for a bottle of wine. What are you, crazy? Of course, here's a guy at the time who spent $900 on a camera because he was a photographer, and that's 20 years ago. So everybody has their thing that they think is a fair value and that somebody else spends money is nuts on. I'm with you, Philip, but the reality is that's what these are the shares. Somebody's buying these stocks because these are the stocks that are driving the market. Well, guys, just like you didn't need to buy $14,000 worth of IBM stock, what if you could control that share of stock for a lot less? Now, obviously, Amazon options are going to cost a lot more than Apple options or a lot more than IBM options. And you might not be able to afford Amazon options, or you might not be able to afford Google options. But you know what? I know what you mean, Philip. I took that the right way. I know. But the point here is not what you and I think. Well, I'm going to get to this in just a second. As crazy as that is for the stock, at least, Philip, you would love to be able to. Philip, I'm sure if I ask you a question, would you love to be able to profit off of Amazon's move? Would you love to be able to profit off of Google's move without having to buy the stock? I'm pretty sure you're going to say yes. Okay. So everybody else, because that's why I learned options 17 years ago. Okay. Now, what if you could, you're going to love this, Philip. What if you could profit off of the FANG stocks or any stock for a fraction of what it would cost to own the stocks? What if you could profit off the FANG stocks without ever having to own the stocks? And Philip, how about this? What if you could profit off of Amazon for less than $5 or $10 a share of risk, even if the stock went to zero? There are option trades, Phil, and everybody else, where they're called option spread trades, where I could get into a bullish trade on Amazon using options. a $3,300, $3,500, $3,600 a share stock, and I can trade it for a bullish options trade for less than $10 a share of risk, even if the stock went to zero. Now that sounds crazy, but for a different reason. Doesn't that make sense, everybody? Wow. What if you could profit on a stock's move even if it went in the wrong direction? You can use options for that. Let me ask another question. Who trades stocks in this webinar? Anybody? What if you could get paid to buy the stocks you want to buy? Where you want to buy it? What if you could get paid to sell your stock where you want to sell it? I don't just mean buy it. I don't just mean buy IBM at 140 and sell it at 170. What if you could get paid to buy IBM at 140 and get paid to sell the stock at 170, which is where you want to sell it? Again, back here, guys. If you're going to buy IBM at 142 and sell it at 170, how about get paid to buy it here and actually get paid a premium to do what you want to do anyway? That's what you can use options for. And I already talked about insurance. Okay? Yes, sir, DMZ. All right, he's talking about cash secured puts, covered calls. We don't have time to get into that today. Guys, especially if you're in America, who has retirement insurance, IRA insurance? Who has stock insurance? Phil, you trade futures. How would you like to have futures insurance? Ooh, isn't insurance just a hedge against loss? Well, let's say Philip buys a futures contract and he needs the asset to go up and the asset goes down. He's going to lose money. What if he had an insurance policy that would make money when the asset went down to offset the loss that the futures contract is taking? Does that sound cool? Guys, if you don't know about options, I think you need to learn about them. If you are in the markets, if you have retirement accounts, if you want to get involved in the stocks that are driving the growth of the market and either can't afford those stocks or just don't want to take on that much risk, learn options. And believe me, first of all, I'm the options guy at Pinnacle. Don't you love it when people say, believe me? Well, I am Moses, so you can believe me. But did I take the concept of options today, and we're only going to go about 5 more minutes here, guys. Did I make the concept of options sound simple? Yeah. And because they are. If you've been told options are hard and options are complicated, now just to be fair, options maybe don't have the easiest learning curve. Options have more moving parts. Think about it. If you can be wrong directionally and still make a profit, options have to have something to them that other asset classes don't have. I don't think options are the easiest asset class to learn, but I think you'll all learn it. But I think they're the easiest to trade. Let that sink in for a second. Look, stocks, buy low, sell high, short high, buy low. Stocks are easy, assuming you know where to buy them and know where to sell them. You got to get that part right. But stock trading is simple. Get the direction right, you make money. Get the direction wrong, you lose money. Duh. Option trading is more complicated. Options are not the easiest asset class to learn. Let's just say it has a higher learning curve. They're not hard, just not the easiest. But when you learn them, I think they're the easiest to trade. And if I asked you what you all do for a living, you're going to give me professions that you had to learn. Some of you had to go to school. Some of you had to get master's degrees or PhDs. Some of you had to get licensed by the state or the county or the country. You had to learn it. You had to intern. You had to apprentice. You had to gain experience. You get it. I have had brain surgeons in class, actual brain surgeons. I've had rocket scientists, guys who work at NASA, who first tell me, man, options are not easy. I'm like, you're a freaking brain surgeon, dude. Okay. So how long did it take you to learn that? So if I made the concept of options sound easy today, that's how I teach them at Pinnacle. Okay. We not only teach you how options work and how the moving parts work, but then we get into trading them live with real money in the market. Where to get into your option trades, where to get out, when to get in, when to get out. etc., etc. Is that cool? Okay. And these are all the things right here that you can do with options. You can profit off a stock's move for a fraction of what it would cost. You can profit off a stock's move. You never have to own the shares. You can profit off the movement of a $3,500 a share stock for less than $10 of max risk. You could profit off a stock's move if you were wrong on the direction. You could profit by getting paid to buy what you want to buy, getting paid to sell where you want to sell it, and you can use options to ensure a stock or retirement position, or even to act as a hedge on a futures or a forex trade. Unbelievable. Okay, that is the benefit of options. And that is the end of our little webinar today, our YouTube session. If you got any last questions, guys and gals, please put them in the chat box. I'm the options guy at the Pinnacle Method, okay? And we just introduced you to options. If you'd like more help in learning how to trade, there's a no-cost webinar tomorrow morning, 12 o'clock Eastern. Also on Tuesday, that is actually going to be presented by me. It's the introductory workshop on the Pinnacle Method. Also, Sam Seiden, the gentleman who put our Pinnacle Method trading and investing workshop together, we'll be doing an advanced workshop also tomorrow and next Wednesday. But if you got any questions about what we teach, why we teach it, how we teach it, the thing that we do at Pinnacle, guys, is we teach you to time the market. Let that sink in for a second. We don't use support and resistance. We don't use MACDs and lagging indicators. We don't use all these oscillators that everybody teaches. We teach you to trade with the institutions. We teach you to trade with the big money. We teach you to look for the institutional order flow. And wherever you would want to buy a stock where the big guys are getting in, that's where you'd want to enter and exit your option trades. So tomorrow morning at 9 o'clock Pacific, 12 o'clock Eastern, or wherever you are in the world, just adjust for the time. I have a 90-minute introductory workshop on the Pinnacle Method. I'll even talk a little bit more about options tomorrow, as well as how we can teach you to time the market. When I say time the market, I don't mean to the penny. I just mean, guys, stock goes up. Is it going up forever? Nope. Stock goes down. Is it going down forever? Nope. Eventually they hit their head and start going down, or they hit a floor and start going back up. What if you could figure out where a downtrending or an uptrending asset was going to stop going up or down? What could you do with that information? Make money or take small losses. All right. I don't see any questions. So, guys, thanks for coming out. The concept of options really is simple. Remember the Dorito. Remember the coupon. I know some of you are thinking it can't be that simple. Oh, yes, it can. We've been taught that investing and trading is hard. And the reason we've been taught it's hard is because people don't want us doing it on our own. The people who tell us to buy and hold make money when we buy and hold. Whether we make it or not, they're making money whether we're losing money. So anyway, come join us at the Pinnacle Method. If you want to learn more about options, maybe I'll see you tomorrow. The concept, hopefully I demystified the concept of options for you today. And if it floats your boat, get educated on them somewhere, even if it's not us, okay? Thanks for coming out today, guys. I really appreciate it. Have a great weekend wherever you live. And hopefully I'll see you all down the road. All right, guys, be well. Bye-bye.